With the market reeling from geopolitical shocks and President Trump's new tariffs, investors are scrambling for safe havens. But here's the good news. There are still high-yield dividend stocks paying over 4%, and they're holding strong. In this video, I'm breaking down 5 rock-solid dividend stocks that not only offer great yield, but are also less likely to get hit by tariff fallout. If you're trying to protect your portfolio and generate passive income during this downturn, this one's for you. Welcome to The Alternative Investor. I'm Robert, and on this channel we uncover real-world investing strategies that help you build wealth in any market. Don't forget to like this video, subscribe to the channel and tap the bell for updates. Want to start investing or add to your portfolio? Grab your free stock from Robinhood, link in the description below. Right now, we're in the middle of a major correction. Trump's proposed tariffs on imports have triggered volatility across multiple sectors. Tech and cyclical growth names have taken the biggest hits. Investors are rotating into defensive stocks, especially those with reliable cash flow and minimal global exposure. That's where high-yield dividend stocks come in. If you choose the right ones, they can offer stability, income, and capital preservation, even while the rest of the market is falling apart. When narrowing down our picks, we focused on 4 key factors. Dividend yield, over 4%. These stocks give you real income, even if prices stay flat or decline. Low global exposure. We're looking for companies with mostly domestic revenue to avoid direct impact from trade wars. Stable or regulated cash flow REITs, utilities and consumer staples do best here. Proven dividend history. These aren't yield traps, they've got a solid track record of paying and raising dividends. Altria Group MO dividend yield approximately 7.6%. Altria is a classic recession-proof stock. It sells tobacco products like Marlboro, high-margin items that consumers keep buying, even when budgets tighten. Altria's operations are overwhelmingly US-based, which shields it from global trade wars. And the company has increased its dividend for over a decade straight. With a payout ratio under 80% and dependable free cash flow, Missouri gives investors a powerful income stream with very little tariff risk. Realty Income O dividend yield, approximately 5.8%, paid monthly. Realty Income is known as the monthly dividend company for good reason. It owns over 13,000 commercial properties leased to high-credit tenants like Walgreens, Dollar General, and FedEx. Most of its leases are long-term and inflation-linked. The company has increased its dividend every year for 30 years, even through the Great Financial Crisis and COVID crash. And here's the kicker. Realty Income's entire portfolio is based in the US. It's immune to foreign tariffs, making it one of the safest REITs in this environment. Chevron Corporation, CVX. Dividend yield approximately 4.2%. Chevron might seem like a wild card, but hear me out. This is one of the most stable names in energy. It's cash flow positive, even with oil prices down, and the company recently raised its dividend again. Most of Chevron's production and refining happens in the Americas, making it less exposed to Asia or Europe's trade risks. While energy can be volatile, Chevron has proven time and again it can ride out tough markets and still reward shareholders. WEC Energy Group, ticker symbol WEC, dividend yield about 4%. WEC is a regulated utility serving millions of customers in Wisconsin, Illinois, and Michigan. Utilities are naturally defensive. People don't stop using power during a recession. What makes WEC unique is its steady dividend growth, 22 consecutive years of increases. It just raised the dividend by nearly 7% again in January 2025. And since all its operations are US-based and regulated, it's completely insulated from international tariffs. British American Tobacco, ticker symbol BTI. Dividend yield around 7.5%. BTI is one of the few international companies making this list, but it deserves a spot. It generates a massive portion of its revenue from the US via Reynolds American. Despite being headquartered in the UK, BTI's operations are broadly diversified and surprisingly resilient during downturns. The company is transitioning toward next-gen products like vapes and heat-not-burn tobacco. That plus a rock-solid dividend makes BTI a top income pick, even with modest tariff exposure. So let's recap. Altria and BTI dominate consumer staples with inelastic demand. Realty Income and WEC Energy are classic defensive plays with rock-solid income. Chevron gives you exposure to energy with less foreign risk than you'd think. Each of these companies offers a different kind of protection, from recession, inflation, and yes, even global tariffs. And that's why in this 2025 crash, they deserve a long look. Which of these dividend giants are you adding to your watch list? Let me know in the comments. Want to start investing today? Grab your free stock using the Robinhood link in the description. Like this breakdown? Give the video a thumbs up, subscribe to the channel, and tap the bell so you don't miss what's next. This is Robert with the Alternative Investor, bringing you smart strategies for wealth building in any market. See you in the next one.